Well, good afternoon. Mark Milam here, your mortgage professional, about 1:45 on the East Coast, March 11th. I wanted to take a minute and make this video to talk about what is happening in the mortgage market because obviously the phone calls are flooding in, the emails are flooding in, text messages, just trying to keep up with it all. And sometimes video is the best way to communicate with folks. So what we saw last week was refinance activity spike to all-time highs as mortgage interest rates fell to all-time lows. And with the week winding up on March the 6th, we started to get a little bit of hint that jumbo investors particularly were so saturated with new loan applications, they were worsening pricing, not because the bond market or the mortgage-backed securities market wasn't performing, but simply because they needed to slow down the pipeline, which was interesting. We started to see mortgage rates decouple, especially in the jumbo arena, decouple from the actual mortgage market. And really, it was based upon investor saturation or investor demand. Pricing was more based on those criteria than it was on what was happening with mortgage-backed securities. Now, not so much for conforming conventional loans, not so much for government loans. So that ended up last week. But we started out this week with just an immense measure of volatility. The stock market, when the stock market goes 1,000 points one way for one day and then has a 1,000-point plunge, another day, the circuit breaker trips, trading stops or ceases for a period of time. And then, we see some improvement yesterday. Today, now the stock market, the Dow is down again over 1,200 points as the World Health Organization declares the coronavirus a global pandemic. Just all kinds of volatility in the market. And when one market is volatile, we're also interconnected. Another market's going to be volatile. So when the stock market is so incredibly volatile, we are starting to see that trickle over into the bond market, into the mortgage-backed securities market, and we're not immune. I'm going to flip the screen around here and show you what's happening. So this is the mortgage-backed securities market. This is what any seasoned mortgage professional who takes their craft seriously looks at to help understand what's happened, what's happening, and what's going to happen, obviously, okay? So we're looking at these mortgage-backed securities, and green days are good days. Green days are days where mortgage-backed securities are trading up in value, rates are coming down. You can see this is last week where we're getting into this wonderful uncharted territory. Refinance activity is spiking. For instance, this movement here on February 28th, that's some of the biggest movement we've seen in the history of the mortgage market. And as we come up here and we start to get to these levels, these are your lowest rate levels that we saw March 6th coming in through the weekend. Now, look at what's happened since then. This is Monday, this is yesterday, that's Tuesday, this is Wednesday. A huge, massive sell-off in mortgage-backed securities. Why? Well, some of it yesterday was the response of the stock market. Today, quite frankly, in reading every trade publication I can get my hands on and reading through all of the subscription services that I subscribe to, no one quite knows, except for there was a huge sell-off in mortgage-backed securities for one reason or another. We're not 100% sure that the news hasn't caught up with what the data is, but I can tell you this. When markets are this volatile, they're going to affect one another. When people are reacting this emotionally, it is going to bleed over, not just into the stock market, but it will eventually bleed over into the market for mortgage-backed securities, and that's exactly what we are seeing. So some of those great pricing levels that we saw back last week are just simply not available today. Doesn't mean they won't be available tomorrow, doesn't mean they might not be available next week, but for the moment, mortgage-backed securities have sold off a bit, which means interest rates have ticked up slightly. We're still in great territory, but compared to where we were 72, 96 hours, business hours ago, we're not quite there any longer. Now, one more thing to note. Next Tuesday and Wednesday, the Federal Reserve will meet in its regularly scheduled meetings, and at 2 p.m. on Wednesday, the 18th, expect the Fed to announce a federal funds rate cut. We don't know yet if it's going to be a quarter point, half point, 3/4 of a point. More clarity on that as we move through the weekend into early next week. But here's the thing to note. The Federal Reserve does not control mortgage interest rates. They simply control the overnight lending rate. It's a one-day instrument. That's what the Fed controls. Mortgages are 30-year terms. They're 30-year instruments that they really don't correlate at all. And sometimes they actually move in inverse proportion to the Fed funds rate. So while it will be interesting to note what the Fed does, and it will certainly grab a lot of headlines, do not expect any kind of correlation to mortgage interest rates. They are much more influenced by what's happening in the mortgage-backed security market. As always, if you have any questions, please don't hesitate to reach out to me, 404-395-1102. Thanks.